Question 1. What is the net present value of a project with the following cash flows if the required rate of return is 12%? Year 0 investment of $42,398, year 1 inflow of $13,407, year 2 inflow of $21,219, and year 3 inflow of $17,800. So in year 0, it's an investment, so it'd be a negative $42,398. The rest of the years are an inflow, so it'd be positive. So year 1 is $13,407. Year 2 is $21,219, and year 3 is $17,800. The rate on this question is 12%. And to solve the MPV, we plug in the rate, and then year 1 through 3, and then we add year 0 on at the end. It is a value of $842.12. Question 2. What is the IRR for the above project? To solve that, we do the IRR function and we do year 0 through 3. Get us 10.89%. Question 3. You are analyzing two mutually exclusive projects. The required rate of return is 14.6% per year for project A and 13.8% per year for project B. Which project should you accept and why? Here are the cash flows for both projects. Although both projects require an initial $50,000 investment in year 0, the year 1 through 3 cash inflows are different. For project A, year 1 through 3 cash inflows are $24,800, $36,200, and $21,000. For project B, year 1 through 3 cash inflows are $41,000, $20,000, and $10,000. So for project A, the initial investment is $50,000, and that's negative, which is the same for project B. 1 through 3 for project A is $24,800, $36,200, and $21,000. For project B, it's $41,000, $20,000, and $10,000. The rate for project A is 14.6%, and for project B, it's 13.8%. We solve for the MPV, get the rate, years 1 through 3, and add year 0 at the end. Project A is $13,157.24. So for project B, it's a value of $8,256.98. Question 4. It will cost $6,000 to acquire an ice cream cart. Cart sales are expected to be $3,600 a year for 3 years. After the 3 years, the cart is expected to be worthless as the expected life of the refrigeration unit is only 3 years. If you want the project to produce positive cash flows in 3 years, i.e. the payback period cannot be more than 3 years, should the cart be purchased? So we have years 1 through 0. Year 0 is an investment of $6,000, so it's negative. And years 1 through 3 are $3,600 each. To solve the cumulative CF, we add year 0 plus year 1. And for year 2, it's the year before, so negative 2,400 plus the year 2. And that's a financial answer. We don't go to year 3 because it'd be over the expected life of the refrigerator. Question 5. An investment project has the following cash flows. Year 0 requires an investment of $1 million. Year 1 through 8 will generate cash inflows of $200,000 a year. If the required rate of return is 12%, what decision should be made using NPV? So for year 0, it's negative $1 million. It's an investment. And years 1 through 8 are 200,000. The rate is 12%, and MPV plug-in rate, plug-ins years 1 through 8, and add year 0 at the end. Get a value of $6,472.05. Question 6, what is the IRR and what decision should be made if the required rate of return is 10%? IRR is years 0 through 8, get us 11.81%, and the MPV, we plug in 10% this time, and then add year 0 at the end to get us a value of $66,985.24. Question 7. Which methods always take precedence over other methods? The answer is MPV. Question 8, which method produces an erroneous result when a project has unconventional cash flows? That is IRR. Question 9, which method should never be used as a decision-making method? That is neither NPV, IRR, or payback method, so the answer is none. Question 10. Marie's Fashions is considered a project that will require $28,000 in net working capital and $87,000 in fixed assets. The project is expected to produce annual sales of $75,000 with associated cost of $57,000. The project has a 5-year life. The company uses straight line depreciation to a zero book value over the life of a project. The tax rate is 30%. What is the operating cash flow for this project? So the sales are $75,000. The costs are $57,000. To find depreciation, we do the $87,000 fixed assets divided by 5 years. The taxable income is the sales minus costs minus depreciation. And the tax is taxable income times the 30% tax. And finally, net income is taxable income minus tax. So bring net income down as well as depreciation. And the OCF is the sum of both of them to get us a value of $17,820.